All right,
Great.
let's start here. What is the main problem, Ben, that financial planning aims to solve?
I'd say that the main problem in financial planning is retirement planning. That's usually where the biggest numbers are. And the problem there is we need to decide how much to save during our working years, how to invest those savings, and how to withdraw from that during our retirement years. Um, so there are obviously other problems like might need to pay off a mortgage, or there might be kids' college tuition payments that might be due. We might be thinking about bequests. So all of those things are things that we naturally start thinking about when we think about retirement planning. So if you need to send the kids to college for a few years, then those are years in which you can't save for retirement. So you naturally have to think about all of these other problems when you think about retirement planning. So retirement is kind of like this big problem around which you can sort of hook all of these other things and come up with a plan for your life.
Hmm.
So the problem is, so it sounds like there are three problems, how much to save, how to invest, and how to withdraw. But the saving and the withdrawing problems are really two sides of the same coin. Uh, so the how much to withdraw during retirement is really a decision about how much to save for the rest of retirement. So it's really fundamentally a spend now versus later decision. So there are really only two core concepts involved in financial planning. The save versus spend decision, consume early versus late. And the other decision is investment. So how much do we invest in stocks versus bonds, and how do we vary that across time?
Yeah, that's a great way to think about it. So, what are the biggest challenges in creating a plan for saving and spending throughout one's lifetime?
The two concepts that make it hard to the point that you can't just sort of wing it or come up with a plan in your head. You have to sort of sit down and figure things out. The two things I would say are the first is pretty well known, which is the problem with compounding. We have very bad intuition when it comes to compounding. We're very good usually at adding, subtracting, multiplying, and dividing. We have good intuition about that. But when it comes to exponents, we lose all intuition. We really have no clue. So if you think about if you take $100 and think about how it grows, if it grows at 5% per year, what would it compound out to over 50 years? Really have no idea at all what the answer to that is. And whether if you change that from 50 years to 60 years, that is start saving maybe 10 years earlier or retire 10 years later, what's the impact of that? We have no idea. If they change the interest rate from 5% to 6%, what's the impact of that? Again, no idea. So we really have very poor intuition. That means that we have to sit down and do the math in order to make a financial plan. So this is fairly well known. Lots of people talk about it. Gets a lot of airtime. But the other thing the other issue that makes us hard that people don't talk about as much is the issue of risk.
Hmm.
We're also pretty bad at thinking about risk. And in financial planning, risk doesn't just show up in simple ways. It also compounds over time. So a bad outcome is a mix of good and bad outcomes, more bad than good. So how does all of these, how do the good and the bad average out over time? Do they cancel each other? How much do they cancel each other? So how risk compounds over time becomes extra hard. So you have this mix of compounding and risk sort of interacting. That really means that we have to think formally about it. Sit down and have a formal model and do some calculations and figure out how what a sensible financial plan would be.
So you mentioned formal models. How effective are simple rules of thumb like the 4% rule and stuff like that for long-term financial planning?
So the problem with rules of thumb is that people are just too different. To come up with a rule of thumb, you sort of have to have this average person in mind. We can construct a plan for the average scenario and present that as a rule of thumb. But people are just too different. So So one person might be looking to retire early, another person might be looking to work till full retirement age because their job is secure and they like it. Somebody else may have a pension on top of Social Security. Someone else may not have much of that. And then there are preferences that are different. Some people may be more risk averse. Some people are more risk averse than others. Some people may be looking to consume earlier when they're healthy in early retirement, and others might be looking to leave a large bequest. So these are just people just differ in all of these ways. And if you try to create all these different rules of thumbs that cater to all of these permutations and combinations, then that gets complex and hard to manage really fast. And it's just easier to go back to the original model and put in your circumstances and your preferences and come up with a custom plan. And it's important to emphasize that financial planning is a big deal. It's going to impact your to the tune of hundreds of thousands of dollars and frequently millions of dollars. So a rule of thumb that may or may not be appropriate to you seems like that it's not a good place for a rule of thumb. When the stakes are so high, we really should be sitting down and figuring out what's right for us, and not rely on a rule of thumb that may or may not be appropriate for you.
Mm-hmm. Yeah, couldn't agree more. So what economic models do we have to analyze these problems?
So there are two main models that we can use to analyze the problems that come up in financial planning. And one is a life cycle model, and the other is a safe withdrawal rate, or SWR method. So the life cycle model is the model that comes out of economics. And I should emphasize that economics is the academic field that studies this problem. And by economics, I'm including finance as a subfield. So all of the concepts involved in financial planning, consumption smoothing, risk aversion, precautionary savings, time preferences, portfolio construction, these are all core concepts that have been developed in economics, and it's natural for people to try to put this together and try to create this model that says how we should save, invest, and spend over our lifetime. And the life cycle model is an important part of economics. Several economists, Franco Modigliani, Milton Friedman, Paul Samuelson, Bob Merton, these are all Nobel Prize winners who have contributed to the development of the model. More recently, we have economists like John Campbell and Luis Becerra who have worked on life cycle on the life cycle model. The model without risk, the simpler version without risk, is taught in undergraduate economics. The more sophisticated version with risk is taught in graduate finance. So this is an important established model in economics. And the other model is the safe withdrawal rate, or SWR model. This was created by a financial planner named Bill Bengen in 1994. And so this ended up being widely used in industry. It's been heavily adopted, and it's kind of like the standard way of doing things in industry now. But the assumptions that are made in the SWR model turned out to be very problematic. So I've been arguing, and others have been arguing, that the life cycle model is a much better approach to financial planning than the SWR model.
So we have this model that's like pretty robust and pretty serious, and it's been studied by like literally some of the smartest people in the world that have lived over the last, whatever it is, 70 years. Why aren't more people using the life cycle model?
That's a very good question. And for people who are aware of the life cycle model, this is kind of like, how are people not using this? And I think fundamentally, at least part of the reason, I think, is that the model with risk, which is really what we need to practically apply this to in industry. The model with risk is more mathematically challenging, and so it's kind of remained fenced off a little bit in graduate finance. But the good news is that the life cycle model is coming out of academia and into a broader understanding and into industry. The trickle over the last 20 years, I would say that the trickle has been turning into a stream. It's not a flood yet, but at least there's definitely a steady stream of talk about life cycle model and applications of the life cycle model. There's been a series of books that's been published over the last 20 years. There's several articles have been published on it recently. The Economist had an article on it a few weeks ago. And You've had several people who've been important to the development of the life cycle model on your podcast. So you've had Bob Merton, John Campbell, Francisco Gomes. These are all academics who worked on the model. So you guys have contributed to it. In terms of applications in industry, is Elm Wealth, the wealth management firm, has been applying the life cycle model for financial planning for its clients. And you've had the principals, Victor Hagani and James White, who've written a very good book on the life cycle model called the Missing Billionaires. You've had them on your show. And even people who've not heard about the life cycle model may be using it because Vanguard's target date funds, for example, explicitly use the life cycle model to construct the glide path for its target date funds. So as long if you're buying if you're investing in a Vanguard target date funds, you are using the life cycle model, even though you've not heard of it. So I think the overall arc of how things are happening here, I think it's kind of like the how index funds came. The idea was sort of first originated in academia, and then some people saw it and really became convinced and excited about it. People like Jack Bogle, and then implemented it, and then it took a couple decades to sort of get established, and then a couple more decades to become a standard way in which well-informed investors tend to invest. So I think the arc of life cycle model is going to be the same. It's definitely been slower than index funds. But given the fact that people, as soon as they see the life cycle model and start appreciating different aspects of it, and there are all these problems with SWR that people are aware of, and they're trying to fix it by doing all of these band-aids and saying, let's try this, let's try that. And all of these problems are just elegantly solved by the life cycle model because it's just starting with better assumptions. So once people see that, people do get excited about it, and so I think that over the coming years, the life cycle model is going to become much more widely used and the standard part of how at least some subset of well-informed investors are going to be investing.
So we've talked a lot about the life cycle model, but let's get into a little bit about how it works. So how would you describe the basic premise of the life cycle model?
So to understand the life cycle model, it's easiest to first start out with the model without risk. And a lot of the concepts can be understood easily in that context, and it'll carry over to the model with risk. So in the model without risk, we just have a riskless asset. We know what the returns are going to be. Let's say it's going to be 3%, 3%, 3% every year. So the problem really is there's no investing problem. You just invest in this 3% asset. The problem really is how much do you save during your working years, and how do you spend out of that? How do you withdraw from that during your retirement years? So obviously the reason we want to save during our working years is really because we don't want to have that sudden drop in spending when we start retirement. But it's worth that's obvious, but it's worth looking at this more closely, and so that we can make sure that this is in our model, that this reason why we want to do this. So the reason we want to spread this consumption, spread spending over time, and not have the sudden drop is really because we have a diminishing marginal utility of consumption. We value the first loaf of bread more than we value the second loaf of bread, which we value more than the third loaf of bread. So this means that you'd rather have one loaf of bread each period because that gives you the most value, the most bang for your buck, rather than two loaves of bread in one period and zero loaves of bread in another period. Because that second loaf of bread is not that valuable, so your utility is declining. So that means that the utility function that's driving this is the utility increases a lot for the first loaf of bread. So it goes up quite a bit on the first loaf. For the second loaf, it goes up less. The third loaf, it goes up even less. It's always positive, but it's kind of flattening out as we get more and more. In other words, it's a concave. The shape is a concave utility function. And that's a really important aspect of how we behave and how we should be making decisions. Is respecting that diminishing marginal utility of consumption, that concave utility function. And I emphasize that because this will show up later. And part of the problem with SWR is that it's not assuming a concave utility function effectively. So it's worth thinking about the role of that utility function. So this concave utility function makes us want to spread spending over time. And usually people wonder, well, what about lumpy expenses? My spending should not be smooth because I need to send kids to college for 4 years and my expenses will be high during those 4 years. And what about legacy and so on? We're talking about smoothing consumption over and above after taking care of these lumpy expenses. So beyond these lumpy expenses, what's left over, we're going to try to smooth those general expenses, the remaining expenses effectively. So handling lumpy expenses is not a problem at all for the life cycle model. You can easily put that into the model. And it's also important to emphasize that smooth consumption is not necessarily a constant consumption. It's not necessarily a flat spending schedule that you're going to try to create. And there are two forces at work here that determine whether it's flat or upward sloping or downward sloping. One is the fact that we typically get a positive rate, a real rate of interest. So after inflation, we still get more money. If you save money, we still get more later on. So if you give up a loaf of bread today, you get 2 loaves of bread in the future. So this is an incentive to try to save more and try to spend more later rather than early, because you can increase your average spending if you delay spending. So that's a force towards scheduling an upward sloping spending schedule. On the other hand, we may be impatient and we prefer consuming earlier rather than later, or we prefer consuming in early retirement when we're healthy and we can travel. We might want to spend more and value that more than spending in late retirement. So this is preferences like this would be called a positive time preference rate. So this time preference rate kind of is conflicting with the positive real rate of interest, and whether or not you schedule a flat upward sloping or downward sloping glide path will come down to which one is the net effect of these two forces. So that's basically the gist of how the model works without risk. So that's how we would save, invest, and withdraw if returns were if we knew what our returns were going to be every period.
Makes a lot of sense. I remember before I understood what the life cycle model meant, and I just read about it or heard it, it always seemed like this kind of mystical, confusing thing. But when you actually hear what it means, it's like relatively simple. It's smoothing consumption over life. Yeah, it's pretty simple and pretty intuitive. I would use pizza for marginal utility though, because eating one loaf of bread sounds awful. The second loaf would be worse.
Maybe it should have been a slice of bread. Huh?
Yeah.
I don't know. Tell that to my kid. Yeah. My kids eat an infinite amount of bread.
Yeah. And by the last slice of pizza, you're ready to throw up. But I'd be ready to throw up after one loaf of bread, though. Anyway. Okay, so how do withdrawals in the life cycle model relate to amortization?
So we talked about how we're going to create this either upward sloping or downward sloping, some kind of spending schedule. If you try to sit down with a spreadsheet and try to figure out, okay, how much can we spend, how much do we need to save, how much do we need to withdraw? We can do that with some simple math. So mathematically, the way we would try to do that is basically a two-step process. Step one would be to calculate the total value of the resources that you have available for spending. So that's your total wealth. And this total wealth includes your savings that you have in your brokerage account and your bank account and so on. But it also includes the present value of your future income. So you would calculate the value of that income, add it to your savings, and say that's your total wealth. This is what's available to fund our spending. Step two then is to take this total wealth and figure out what kind of spending can you schedule with this total wealth. So if the interest rate is 3%, and if you want spending to grow by 1%, what can you spend? What would you spend every year? So the process of doing that is it only involves high school algebra to figure out. The process of doing that is called amortization. And it's the same technique. It's a standard tool in finance. It's the same technique that we would use to figure out what kind of monthly payments you would need to make in order to pay back a loan. That would be amortizing the loan into the series of monthly payments. So in the same way, we can amortize our wealth to figure out what our spending schedule that it can fund would be. And you can do it with the high school algebra, with formulas and so on. But in a spreadsheet, you can use a convenient function called the PMT function. So a lot of people who are amortizing the portfolio using this technique are typically using that PMT function in Excel or Google Sheets.
Mm-hmm. And how do amortization-based withdrawals change when you add risk?
So when we add risk, we don't know that the returns will come in at 3%, 3%, 3%. We might expect that the returns come in at 3% per year, but returns are going to come in either higher than expected or lower than expected, and rarely sometimes even as expected. So what do you do when returns come in higher than expected or lower than expected? It's simple and straightforward. You just recalculate. You just amortize your wealth again. So because if returns came in higher than expected, then your wealth is let's say it's 10% higher than you thought it would be. So if you try to amortize that, you would get a spending schedule that's 10% higher than it was before. So the important thing is all of your spending, you're rescheduling all of your spending. It's not just like the current year. You're rescheduling all of your spending and lifting all of it up by 10%. And then the next year, if your wealth is 5% lower, your spending goes down by 5%. So you keep jumping onto these new schedules. You jump up to a higher schedule when the returns come in better than expected, and down to a lower schedule. And so you trace out what the spending sequence that it traces out is basically, so it is you trace it out on the back of these changing schedules, and it's variable spending. It's not fixed spending because you're constantly recalculating. So that's the process of how you would do this. But now because we're doing this, because the future returns are not you don't know what there's uncertainty about future returns. A new force comes into play, and that's precautionary savings. And that's a very natural instinct that we have. Because we don't know what the future is going to be like, it makes sense to be cautious and spend a little bit less now, just in case the future turns out to be lower than expected. So now we have a third force to add to the real rate of interest and the time preference rate. Now you have this precautionary savings motive that will say that you should try to create an upward slope, or you should increase the slope of your spending more than you would based on just these other two factors.
You should increase the slope of your spending. So just to make sure I understand, precautionary savings suggests that you should increase the slope of your spending so that you're starting out with more and increasing your spending later.
Starting out with less. So you spend less early on so that you spend more later on. So the slope goes up.
Yes, sorry, you're spending like you have more capital early on, so you're spending a
Yes.
lower amount of your capital, and then as your lifespan gets, your expected remaining lifespan gets shorter, you're able to spend at a higher rate. Is that it?
Yes, and because the lifespan thing is already included in that original amortization. So we've already scheduled that out. So if returns go as expected, you'll stay on that original schedule, and you'll keep shortening your lifespan, and you've already accounted for that in that original schedule. So
Right.
the lifespan itself would not drive an increased spending in later years. What's driving it would be the fact that you have chosen to schedule less early and more later.
Okay. Got it. So it's just
So
a preference.
that's what's creating. Right. Yes. Yeah.
Okay.
Yeah, just precautionary, right? Just a buffer essentially against the uncertainty of future returns or the downside.
Exactly.
Okay.
Yes.
Yeah, okay, that makes sense. Now, so we're talking about variable spending now, amortization-based variable spending. How does that fit with the consumption smoothing that we talked about earlier?
Yeah. So this is an area where there's a lot of confusion or a lot of misconceptions. Usually, people think that fixed withdrawals would be most consistent with consumption smoothing. Because what could be more smooth than just keeping your spending the same as it was before? And the problem is that when you have a portfolio with risk, you don't really have the option of truly fixed spending. Fixed spending is just spending that's fixed for a while, and then you run the risk of a big drop in spending if you run out of money. Basically, and that's a really bad thing because that first loaf of bread is very valuable to you, or the first slice of pizza is really valuable to you. So you don't want to put that at risk. And so the most smooth you can make spending when you're spending out of a risky portfolio is to make adjustments as quickly as possible, so that those adjustments will be small. So quick also means small adjustments. If you wait, you'll have to make big adjustments. So you'd want to make frequent small adjustments so that you don't face this risk of potential big drops later. So this is a variable spending that keeps updating to the new realities is the most smooth that we can make consumption be when your portfolio is risky.
Makes sense. So with amortization based variable withdrawals, you talked about how spending needs to change. How would it change if the portfolio dropped, say, 10%?
Yeah, so this is an area, this is something that people are concerned about a lot. Whenever they start thinking about variable withdrawals, the first thing they worry about, it makes sense to worry about how variable is that and how low can it go? And these are exactly the that's exactly the right thing to think about. But usually when people think of a crash, they think the most dramatic crashes are the stock market crashes, which can drop by a lot in a year. It's important to remember that the stock market, your stock portfolio is only a portion of your savings portfolio, and that's only a portion of your total wealth. So there's some layers between the stock crash and the total wealth. So a 15% drop in the stock market might only be a 10% drop in the savings portfolio, and that might only be a 7% drop in your total wealth when you factor in your future income. And even beyond that, usually your total wealth is only part of your total wealth is allocated towards retirement spending. A lot of people may have legacy goals, and so your wealth is funding both retirement spending and legacy. And usually, you'd want to take more risk on your legacy. It's appropriate to take more risk on legacy than on your retirement spending. So that 7% drop in total wealth might might be only a 5% drop in the funds that in the wealth that funds your retirement spending. So that's an extra layer of separation from the portfolio down to your spending. But let's say we have a 5% drop in the 5%. All of this has caused a 5% drop in the wealth that's allocated, that's funding our retirement spending. So then, do we need to reduce our spending by 5%, less than 5%, or more than 5%? And that depends on what you believe about expected returns. So if you think that expected returns now after the crash is the same as it was before. So let's say you thought it was 5% real returns for stocks and 2% real return for bonds. And after the crash, you still think it's 5% for stocks and 2% real for bonds. Then your wealth has declined by 5% and it's not growing any faster because your expected returns is staying the same. So then your spending would, when you amortize your spending, that would drop by the full 5%. So then you would try to reduce your spending by 5%. But usually when after a crash, you can reasonably expect that the expected returns has gone up because valuations, if you base your expected returns on valuations, which fundamentally makes sense, part of the drop of stocks and all of the decline in the price of bonds can be attributed to changes in the discount rate, which is the expected return. It's not necessarily because your future payouts are reduced. It's because you're valuing it less. So expected returns goes up. And so if you adopt that model, then even though your wealth went down by 5%, it's going to grow faster now. So your spending needs to, when you amortize your spending, you need to drop that down only by 3%, for example. So this actually brings up the fact, and people, I think John Campbell and John Cochran have emphasized this, is that it's important to focus on spending. What did the crash do to your spending? And that may look quite different from usually it's better news after a crash than if you just focus on what's your assets worth. So you make those connections from the, if you move from that assets that you have, what the brokerage statement says, factor in your future income and then factor in the increased expected returns. That's what tells you your spending, and that might be that usually is not as bad as the market crash.
Yeah, it makes a lot of sense. That's not using the life cycle model, but when COVID happened and asset prices fell a whole bunch, we tried to really quickly update our expected return assumptions because clients' financial plans looked a whole lot worse with lower asset prices and no change in expected returns. But they actually didn't look that bad once you accounted for the increase in expected returns based on lower valuations. So that definitely makes a lot of sense.
Exactly. I think it's a very important safeguard against behavioral, this worry, trying to sell during the stock market crisis and stuff. If you make that adjustment, it's just a lot smoother and you just feel a lot more calm.
Yeah, definitely.
Well, and Ben, to that point, that doesn't even include the present value of future earnings as well, right? Like that's just looking at the portfolio itself. And so I think it's obvious, but it follows from that younger people who have a longer runway, I guess, for earnings are even less affected than somebody approaching retirement with the life cycle model. Yeah,
and usually young people would be benefited.
Right.
They'd actually welcome a crash, right? So factoring in the future income, now it's going to grow faster. They might have only a few $1,000s in their portfolio, and that crashed by half. That's not a big deal compared to the fact that all of their future savings is going to grow faster now.
Yep.
So you've done a ton of modeling on this, Ben. We can talk about your tool maybe later. But when you run simulations in historical data, how much variability in spending do you see when you're using this approach?
So I looked at U.S. data from 1871 onwards, and to try to simulate what would happen if you followed the life cycle model. And this is definitely not an exhaustive study by any means. I didn't look at all possible cohorts. I lumped things up into years rather than months and things like that. But I think it's sufficient to give a flavor of how the life cycle model would work. So assumed a 35-65 allocation on asset allocation, fixed asset allocation on total wealth, which because of the presence of Social Security would be was on average about a 50-50 allocation on the savings portfolio during retirement. So I think of that as sort of like a normal thing that people would have done historically in terms of asset allocation. And I assume that the investors would update their expected returns based on valuations. So CAPE or the price earnings yeah, ratio for stocks and the estimated real yield for bonds. These are nominal bonds, so they can't see the real yield, but I assume they were estimating it based on the nominal yield and past inflation. Um, so in that setup, with those assumptions, so what I found, the year-to-year variability in retirement spending that I saw for the cohorts that I looked at is, and I look at cohorts every 10 years, not every year. But for the cohorts that I looked at, the standard deviation of the year-to-year spending was variability was 6%. So that means roughly two-thirds of the time, uh, the uh, the change in spending would be 6% or less. And about 95% of the time, so almost all of the time, the change in spending would be twice the standard deviation or 12% or less. And the biggest decline that I saw was in 1 year was for one of these cohorts was 16%. So that gives a flavor of the year-to-year variability. But if you look at the big events that people are most worried about, the Great Depression and things like that, so there would have been 7 events over the last 150 years during this time period. Uh, so there's World War I, Great Depression, the 1937 recession, shortly after World War II, then the 1970s where there was the oil crisis, and then a subsequent bond crash, and then the tech crash of 2000, and the subprime crisis of 2007, 2008. So if you look at all of these 7 events and see how did spending respond during these cumulatively over the course of these events. So in the worst events was not the Great Depression because even though the stocks did really badly during the Great Depression, bonds would have helped a lot. So what matters is how the combination of how both stocks and bonds do. And so with that, for that, the worst declines in spending was actually World War I, where spending would have declined 26% over 5 years from 1916 to 1920. And the 1970s where spending would have declined by a cumulative 37% over 9 years from 1973 to 1981. So these were the two worst periods. The other 5 periods ranged from 11% to 20%. And interestingly, the Great Depression was on the lower end of that, in the 11 to 15% range. And the two recent crises, the tech crash and the subprime crisis, would also be on the lower end of that, between 11 and 15% decline in spending. Also keep in mind that this was done with so this simulation is assuming nominal bonds with no duration matching. So if you use inflation-adjusted bonds and duration match that, you could potentially reduce the variability beyond this.
Man, it makes me think. So like, that sucks that your spending declined. But then as I'm thinking through it, doing it this way sucks less than just spending less over your whole life, like you would be with a safe withdrawal rate. Does that make sense?
Yeah, and we can put that in if we want to just be cautious and spend less, and so that these kinds of crashes don't affect us too much. We can just reduce spending early, so you can create a spending schedule that starts out slow and is expected to go up a lot, so that if a crash happens, it doesn't go that low. So we can tune that in. That can be our preference. That look, I'm worried about the Great Depression or the World War I type or the 1970s. So I want to be very cautious,
Hmm.
and you can amortize with that in mind. So so here I assumed a zero spending tilt that they were not doing that. So you can definitely tune that to so that when you compare what the outcome of a crash like this would be compared to your starting spending, you don't want it to drop too low. So you start out low and then slowly climb up if the market does well.
So this all sounds great from a spreadsheet perspective, but I think Ben would agree with me here that in practice, people, or at least the clients that I've worked with, don't like variable spending, or at least not large swings in variable spending. So how can this be tailored to individual preferences?
Yeah, so one of the big variables about how much variability we want to inflict on the plan, it would be one's risk aversion, right? So we'd have to try to figure out how risk averse they are, and so the more risk averse they are, the more they're willing to have a lower expected spending, but with less variability around that. And so you'd have to put them more in bonds and try to duration match inflation adjusted bonds and so on, and try to reduce the risk on the portfolio side to match that produce less variability in the model itself. And then there are these and then there's this thing that we can do, which it sounds like you guys are doing, which is to update your expected returns
Hmm.
so that even though the market crashes, the spending doesn't decline by as much. It's a sensible thing to do. And then I think it's okay uh, to delay our adjustments. I mean, I think it should be explicitly okay to delay our adjustments because we can't change all of our spending at the drop of a hat. There are consumption commitments. We can't move into a smaller house at the drop of a hat. So even if the model says, well, you're consuming $50,000 before, but now you need to drop because the markets did badly, you need to drop to $40,000. I think it's important to see that new $40,000 for without be clear that okay, we have to head towards this new reality of $40,000. But you can take your time doing that. The sooner you do, the less it's going to drop below 40,000. But it's reasonable to take our time to do that. And I think the more dangerous thing is to not know that, right? To
Hmm.
not know that the new reality is 40,000 and sort of hide that and keep going at 50,000, and then you may be in for a rude shock later on. So I think it's better to see that and then be slow to adjust than to not realize that in the first place. And then there's also this other thing that we talked about before, which is sometimes when people are talking about year-to-year variability and expressing concern about year-to-year variability, they may not care that much about year-to-year variability. They may be worried more about absolute drop in their spending, that the spending doesn't decline as much as down to like really low levels. So if that's what they're concerned about, then we can control that with that spending tilt. That you use precautionary savings, spend less now, schedule more later, so that things don't drop as low. So I think it's important. That doesn't help with year-to-year variability, but it's the separate thing. So I think it's useful to try to separate out what is it that you're worried about. Is it the year-to-year variability, or is it the absolute decline in absolute spending that you're worried about? And it's different tools to address the two different things.
So we've been talking about this, but we haven't really explicitly called it out, but you've been talking about like real returns, right? So these are all inflation adjusted numbers. And so when you mentioned like, your spending might have to go from 50,000 to 40,000, and maybe it makes sense to delay that adjustment. Would another way to do that be to just keep the withdrawals perhaps fixed if the model allowed for it and not make those inflation adjustments? That might be easier to stomach perhaps for some investors.
Yeah, that would be a sort of like a behavior filter on this, and I think people definitely are care about nominal numbers. In our spreadsheets, and economists don't. We assume it's what we care about loaves of bread and so on. But people do care about the the nominal numbers. And if people are really uncomfortable about they're comfortable taking a real cut, but much more uncomfortable taking a nominal cut, then I think it makes perfect sense to be generous when a little bit generous on the nominal side and say, okay, let's try to be let's not try to cut below that nominal amount, but let's give up the inflation adjustments. I think that's a very I think given the fact that people do care about nominal numbers, I think that does make sense. Absolutely.
Well, one thing I was thinking about as you're talking about different ways to limit the variability in spending is the episode we recently did with Peter Mladina about kind of immunizing a portion of your spending.
Yes,
We don't
yeah.
have the best tools to do that in Canada because the real return bond program that we have is being wound down by the government. But in the US, for example, you could use tips to make it so that that portion of your expenses could be totally fixed and like you wouldn't have to make adjustments. And then it's just down to the mix of how much risk you want to take with your spending variability.
Yeah, absolutely. It's a shame. So yeah, I heard that news recently that Canada is winding down the real bonds, and it's a shame because it just makes so much sense to have inflation-adjusted bonds. Nominal bonds don't make any sense. But like, why would you want $100, 30 years from now? I want to know how many loaves of bread or slices of pizza I can get 30 years from now. So for me, yeah, I mean, real bonds make a lot of sense, and yeah, duration matching that to your liabilities is I think makes a lot of sense, and so I think starting with your liabilities, things that you're not very flexible on, like maybe your mortgage payments and at least some part of your college tuition, kids' college tuition, and things like that, and creating a liability match portfolio that takes care of that, and either nominal if the liability is nominal, like mortgage liabilities would be nominal, but real liabilities matching that with real bonds and duration matching it so that you're immune to interest rate risk. I think that makes a lot of sense. That's a good starting point and then take risk, hold both bonds as well as stocks above that.
So we talked about some of the instances where spending has declined when you model this out in historical data and the magnitude of changes in spending. But if we think about a spending drop, how quickly does it tend to recover back to the previous real spending amount?
Yeah, because during a crash, we reduced our spending in line with the crash. So we kept re-amortizing, recreating the schedule, just updated our spending. So as the crash happened, we went down with the crash. Now, if the markets recover, we get to recover with the market. So it would be immediate in that sense, or as soon as the market recovers, spending would recover. But it's important to emphasize what market recovery and portfolio recovery means in this context. So market crash was lower than expected returns year after year after year. So let's say 3 years of like lower than expected returns brought you to the bottom of the crash. And to get back to the top, to where you were before, we need higher than expected returns. The expected returns won't take us back to the original schedule. We need higher than expected returns to bring us back. So the investor at the bottom of the crash is not expecting to come out of the crash because they don't know that returns are going to be higher than expected. But we as researchers, we can look at the end of the crash. We can say, well, this was the bottom of the crash, and we can see that the market will recover from this point on. And we can ask, how quickly did their spending recover with the market? So with that benefit of hindsight, so these crashes, these 7 crashes that I mentioned earlier, the average drop during these 7 crashes. Drop in spending was 21%, and at the bottom. And then if you look at this, what spending would have been like 3 years after the bottom, the drop had reduced to a 15% drop. And then if you look 10 years after the crash, the drop would have reduced to 6%. So 21% drop would have reduced to 6% 10 years after the crash. I mean, the investor would not have known that at the bottom of the crash, but we can look back and see that it did recover. And the main point here is that if the market recovers, the spending would also recover with it.
Right.
Yeah, makes sense. And maybe I just missed this, but how, like, is this a continuous calculation, or like how frequently are you updating or re-amortizing these calculations?
So for the historical analysis that I did,
Yeah.
so I did it at a yearly basis. So all of the
Okay.
returns, I made it annual returns and then assumed they're recalculating every year.
Gotcha. Okay. Makes sense.
So yeah, I may not have gotten the absolute bottom of the crash and so
Yeah.
on because the monthly would have been much better for
Yeah.
for that. Yeah.
No, it makes sense, because I'm just thinking in practice how often somebody should consider updating their own model of this, right? And so just making sure I understand that what you're talking about is essentially an annual update, but it depends, I guess, right? It depends on the severity, the speed, the depth of the crash. Something might happen externally that would trigger you to update this more frequently than once a year, right?
Yeah, I mean, if the markets go down a lot and you hear about it in the papers and stuff, I think you'd want to update
Yeah.
with like some big movements. But with regular market movements, maybe once a year is enough. Some people may want to do it once a month. But I think it is that separation between seeing what the target is and actually making changes in our lives. I think it's good to have that separation. So seeing it frequently is okay, as long as people don't feel anxious and feel that they have to change right away.
Yeah. Gotcha. Okay. That makes sense. Switching gears a little bit, what does the life cycle model say about asset allocation?
So when it comes to spending, the life cycle model was telling us to spread spending over time. And when it comes to asset allocation to investing, it's kind of telling us a similar thing. It's telling us to spread risk across time. So what do we mean by that? So let's think of a case example where we have some resources now, $10,000, say, and we are going to use that to fund spending 30 years from now. So this is the only goal. Let's remove all the other years to keep the model simple. So we have this money and we have this goal, and how do we allocate this goal? Sorry, how do we allocate these funds? So the big driver there is going to be our risk aversion. So the more risk averse we are, the more we'd want to invest in bonds and have less variability around that outcome. So let's say we are the sort of person that should have 50% stocks and 50% bonds. So now the question is what is the glide path that you should have? Should you maintain a fixed 50-50 for all 30 years? Should you start lower than that, 40%, and then increase to above 50%, go up to 60%? Or should we start at 60%, come down to 40%? What should be the glide path that averages out to 50%? And the answer that the life cycle model tells us, so what it's saying is hold it steady at 50-50, keep it flat, keep it a fixed asset allocation at 50%. And it's important to note right away that this is on all of your resources. So this would be the recommendation on total wealth, not on the savings portfolio, where people are more used to that downward sloping glide path. It turns out that this fixed asset allocation on total wealth will imply a downward sloping glide path on your savings portfolio, and we can talk about that later. But look at this case where you actually had the $10,000 in your hands, so this is your total wealth, and there's no more income coming in to fund that goal. So the asset allocation on this should be that fixed 50% the whole time. And the intuition for that is time diversification. This result is referred to as sometimes referred to as time diversification. So basically, what you're doing is taking an equal bet every year, every period. So keeping your risk the same. So rather than take on a lot of risk in one year and less risk in the other year, in some other year, you're taking on the same risk every year. So that's what maximizes this risk sort of averaging out. Risk doesn't completely average out; it doesn't go away, but you're trying to get it to average out as much as possible by taking a series of small bets rather than a big bet followed by a small bet. And it turns out that if you keep a fixed asset allocation, because of this time diversification, there will be no sequence of return risk on this on this how much balance you're going to have at the end of your 30 years is going to be independent of the order of returns that it came in. So if you look at the math of the compounding, you can see that the returns all kind of it's all multiplicative, so you can put it in any order. And so this $10,000, it doesn't matter whether you got 10% followed by 5% or 5% followed by 10%. All of that will compound out to the same amount. So you eliminated sequence of return risk in this problem. Now this is a limited problem. Yeah, you want to think about like the whole many different years and many different goals and future income and things like that. But this is the basic principle around which that's built. So when you have multiple goals, all with the same asset allocation, your glide path will still be flat because all of the individual goals are being allocated at 50%. So that fixed asset allocation will carry through to multiple years, even though here we just looked at one specific year. Of course, if you have multiple goals, and usually people have legacy, which will be allocated more riskily. So then you would have that coming in, and it won't be flat. But if you're just talking about all retirement years, all funded with 50%, then the fixed asset allocation would apply to total wealth, not to the savings portfolio.
We've alluded to expected returns a few times. How important are expected return assumptions to life cycle asset allocation advice?
So the expected return assumptions will matter a lot. So small changes in the expected return will imply large changes in the asset allocation. But I think of that as the nature of reality. So expected returns do have a big impact on the financial plan. Any reasonable model will have to assume an expected return, and it's going to have a big impact if it's a sensible plan that's looking at how things compound over time. And usually when people think that they're not making an expected return assumption, it's because they're doing it implicitly, usually by doing a historical simulation. And if they're doing that, then basically the expected return assumption is the historical average, which is quite high. Given current valuations, that would be a very, very optimistic expected return assumption to use. So I think that's why it's important for people to not hide the expected return assumption like this, and to sort of pull that out and stare at it and see if it makes sense. But people like to hide it because it's hard to think about, and it's hard to face the fact that expected returns do matter, and we don't when it comes to stocks, we kind of have to guess a little bit and try to make our best guess, and it's not very obvious, what that number should be. Bonds is easier because we can see the real returns of bonds, the inflation-adjusted bonds, but stocks is harder. But we really have no other option, and it's good to face that fact. So to put some numbers on how much it matters. So if you take if you assume an expected return of 5%, real return of 5% for stocks and 2% for bonds, and so that's an equity premium of 5 minus 2 equals 3%. If for an investor with a relative risk aversion of around 3, that would imply Merton's formula would imply a stock allocation of around 30%. And if you increase the equity premium by 1% from 5% to 6%, then that would increase the stock allocation recommendation by 40%. These are to around 40%. And again, these are asset allocation on total wealth, not on the savings portfolio, which is different. But the 1% increase in the equity premium or caused a increase in the stock allocation from 30% to 40%, and that seems pretty significant to people, and that is significant, and people are uncomfortable with this because if you're basing expected returns on valuations, that's going to change from week to week and month to month, and they'll see large changes in what the model is saying the asset allocation needs to be. But if you look at what if you look at what happened with the equity premium, it increased from 3% to 4%. So that's a 33% increase in the reward offered by stocks over bonds. So that is a big deal. It should, in a sensible model, that would have a large impact on how much stocks versus bonds you hold. So we can create a model that doesn't have that impact by you can take the life cycle model and then dampen the change in expected returns before we feed it in. So when you see a 1% equity premium change, you say it's only a 0.5% or a 0.25% before you throw it in there. And we'll get a model that's not very sensitive to the expected return, but that would be the wrong model. It's not telling you the information that you need to know. And the information is that wow, it looks like stocks are returning a lot. Your belief is that stocks are going to be returning a lot more over bonds than you thought before. So you should increase your asset allocation by quite a bit. It doesn't mean that we have to, again, coming back to that, it doesn't mean we have to adjust right away, but it's good to have that clarity in okay, this is the new recommendation. Let's work towards that. Let's apply new contributions towards that. We don't have to, go out and sell a lot of assets in a stock in a taxable accounts and things like that. But it's good to have clarity on what the goal is and what we need to be working towards.
So how does the advice change if we assume that we have limited information about how expected returns vary through time?
So the best guess about future expected returns is the current expected return. And there's a very simple reason for that. And that is if you can predict the direction of the change in expected returns, you should be able to make a lot of money. There's huge arbitrage opportunities available because even if you can predict it just a little bit, you can predict that it's going to go down by 0.25% or 0.5%. That will imply a large change in the price of the asset. And so you should be able to do short-term trading to profit off of that. So given the fact that well-functioning financial markets cannot leave such opportunities on the table, our best guess is that future expected returns we're expecting that it'll be the same as the current expected return. But we know that these things do vary over time. We just don't know in which direction they're going to vary. So the constant, so assuming that expected returns are constant is not exactly right, but it's not too bad because you're at least in the middle of the set of possibilities. You're kind of in the average. You'd be right on average. So it's not too bad to in a simple full financial planning. I think it's not too bad to assume constant expected returns. Make that assumption. But that said, we recognizing the fact that interest rates do change over time. On the bond side, we can use duration matching to limit the impact of that. So that would be a sensible thing to do in light of the fact that we don't know how it's going to change, and we want to minimize the impact of changing expected returns.
How does the typical retirement asset allocation glide path that we see in, like you mentioned, Vanguard's target date funds, how does that compare to advice from the life cycle model?
So this comes back to that fixed asset allocation result on the total portfolio, and what would that imply on the savings portfolio? So the savings portfolio is we're basically going to try to create an asset allocation on the savings portfolio in order to get that fixed asset allocation on the total portfolio. So you look at a person at the start of their career. They might have only $1,000 of savings, let's say, and almost all of their wealth is in the form of future income that they're going to receive over their career. So let's say the value of that is $2 million. So their wealth is $2,001,000. And most of it in the form of this human capital, this future present value of future income. So the question is how should they think about that human capital? Is it more stock-like or bond-like? Our incomes tend to be relatively safer. It's not perfectly safe. Of course, we don't know exactly what our income will be, but it's a lot safer than stocks, and it's closer to bonds than it is to stocks. So an assumption that economists have suggested is to assume that our future income, this human capital is bond-like, that this $2 million is bond-like. So then that tells you what you need to do in your savings portfolio. The savings portfolio is only $1,000. Even if you invest all $1,000 into stocks, when you look at your total wealth, that's still too little stocks. So you want to maximize, put all $1,000 into stocks. And then over time, the human capital part reduces because you have less and less years remaining to collect your future income. And uh, the financial capital, your savings portfolio increases because you have more and more savings and that's grown. So at some point, the savings portfolio is going to be large enough that you shouldn't be 100% stocks on that. You'll need to hold some bonds in order to get to that 50-50 target for on your total wealth. And then as you keep moving forward, that allocation will keep reducing until when you reach retirement, if you don't have any further pensions or Social Security coming in, then all of your total wealth is in that savings portfolio. So you should apply a 50-50 allocation on the savings portfolio. And then hold that constant at 50-50 through the rest of retirement because you don't have any more income coming in. That's your full wealth. So the shape of this would be the glide path would be 100% stocks in early career, and then dropping down below 100% in the second half of your career, and then becoming flat at your target allocation, in this example of 50-50 in retirement. And if you have some if you have some pensions and Social Security, then instead of 50-50, it would increase to reflect that. It might be 60-40 in retirement, but it would basically be roughly flat in retirement if you have pensions running all the way through retirement. So the basic shape is flat, downward sloping, and then flat again. And this is quite different from a straight line going down. So a linear rule like age and bonds and so on, that would have a linear constant slope. This is very distinctive. It's this flat and then downward sloping and then flat again. So if you look at Vanguard's target date funds and actually other target date funds as well, if you look at the slope of those glide paths, it does follow their slope. It's flat and then downward sloping and then flat, and that's because it's coming from this life cycle model that's telling us to try to maintain that 50-50 allocation or some fixed asset allocation on the total portfolio.
Makes sense. And I think you've already answered this next question, or at least you mentioned it, but how does asset allocation in the model change based on the time horizon of the specific goal being funded?
So this is an area where there's a lot of confusion. So generally people think that that stock risk sort of goes away over time because of the law of large numbers, because of averaging out. So if you look at longer horizons, there's more periods, and so you're taking if you look at the average stock return over long periods, you're averaging over more returns, and you should expect a tightly distributed return. And you do get that. You do get that the returns over longer and longer horizons get more and more tightly distributed. There are very dramatic graphs that show this. And so that's not wrong. So even if returns are independent, the return distribution will become more and more tight. But that still does not mean that stocks are becoming less risky over time, because what you care about is not the average return over the full period. You care about the final balance, because that's what you're going to spend. You're going to be spending dollars, so we should be looking at how many dollars you have at the end. So small changes in the realized average return over long periods translate to large changes, compound out to large changes in the portfolio balance. So if you look at the portfolio balance, that is becoming more and more widely distributed when you look at longer and longer horizons, if returns are independent. So this was the fallacy of time diversification. So I mentioned there was the correct version of time diversification. There's the fallacious version of time diversification that says that for longer and longer goals, you should hold more stocks, because if returns are independent, then they average out and you can appeal to the law of large numbers. But that's looking at the wrong thing. It's looking at stock returns instead of looking at the balance. But it turns out that even though risk is increasing over time, the reward is also increasing over time. So longer periods also have a high reward, because that equity premium compounds out to a very massive difference over long horizons. So both risk and return are increasing over long horizons. And if returns are independent, then both risk and reward are increasing over long horizons. And if returns are independent, they're increasing at the same rate. And so the asset allocation becomes independent of the time horizon. You hold the same asset allocation over long horizons as you do over short horizons. But now, if you don't assume independent returns, if you have mean reversion in returns, so good returns are more likely to be followed by bad returns, and bad returns are more likely to be followed by good returns, then you get this extra canceling out happening beyond the independent return assumption. And then the risk would decline. So even now, risk is increasing over time. So over longer horizons, risk is still more than over shorter horizons, but it's increasing at a slower rate than the reward is increasing. So the reward to risk ratio improves over long horizons. And so based on that, you can say that you can hold more stocks for long-term goals and more bonds for short-term goals. But it's important to recognize that it requires mean reversion and not independent returns.
Yeah, that part's super interesting, because stocks, it depends how you look at it, I guess, and how much statistical reliability you want to say that it's there. But there's probably some mean reversion in stocks and probably some mean aversion in bonds, which makes that whole time horizon versus asset allocation thing extra interesting.
Right. So we should generally expect that there would be mean reversion because of that expected return. Like when things go down, the expected return goes up, so you can expect something going up. So if you look at, if you're considering duration matched bonds, then there would be mean reversion, because by like just mathematically it came down, so it's going to go up faster. But yeah, it's when we look at interest rates are moving all over the place. It's not duration matched. Then you can get but even with mean reversion, things depend on the horizon. You could have that thing slowly go down and then over the long run go up. So you may have momentum over short horizons and then reversion over longer horizons. But if the bonds are duration matched, then we can say at least over the long horizon there would be.
Duration. I was thinking nominal bonds for real liabilities. Right. Then that's where in like some of the empirical research that I've seen in a couple different papers recently using two different data sets come to kind of the similar conclusion that bad nominal bond returns in real terms tend to be followed by more bad real returns. Right.
So I think there's just like a lot of things we can do on the bond side to sort of just improve things, right? Because it seems like there's some things we can do mathematically that would improve on outcomes compared to holding nominal bonds without considering duration.
Yeah, definitely. What about wealth? So time horizon is one thing. How does asset allocation in the model change with different levels of wealth?
So we can ask a question, if our wealth doubled, it's total wealth, so our savings portfolio doubled because, let's say, returns came in higher than expected, and income doubled, value of income doubled because our got a promotion and our salaries doubled. So everything doubled. Wealth is twice as much as it was before, and so spending is twice as much as it was before. So then the question is, uh, previously, let's say we were holding a 50% allocation on the stock allocation, 50/50 stock bonds. So now should you increase beyond 50/50? Should you make it 60%, or should you decrease your risk and make it 40%, or should you keep it the same at 50%? And the answer is that all three are reasonable. You could reasonably have preferences that lead you to do any of these things. So you could be the sort of person who says, after their wealth and spending has doubled, they say, well, now the downside is not scary anymore from taking risk. I'll have so much wealth, I'm still not going to lose my house and car. So I'm going to take more risk and increase my stock allocation. And on the flip side, you can say, I have now that I'm so wealthy, I have everything that I need. And what can I do even if stocks do well, like even if my markets do well, like there's nothing more that I value. This is a person whose utility curve is really flattened out. That may still be upward sloping, but it's flattened out, and they're just very satisfied with where they are. That's a person who'd want to cut their risk. So from 50%, they'd bring it down to 40%. So this would be called increasing relative risk aversion, because their risk aversion has increased when their wealth increased. And the other one would be decreasing relative risk aversion. And in between these two, we have constant relative risk aversion, a person who says that who would maintain the same allocation as they did before. And I think it's important to recognize that all of these are reasonable utility functions. They can all be expressed by a nice concave utility function. There's no bad, weird, there's nothing illogical about any of these things. And and I think it's important to say that, because to say that sometimes, because sometimes people argue about this. They're like, oh, it should go down. Because you have, and that's usually because they're looking at only one side of it. They're focusing on the fact that they can't afford to take more risk, or they're focusing on the fact that they don't need to take any more risk. So they're really arguing for their own preferences, that everybody should think like this. But it's really just a matter of preference, and all of these are reasonable utility functions.